This episode is brought to you by Blockdaemon. You'll be hearing all about them later from me later in the episode, but now, on with the show. All right, everyone, welcome back to another roundup edition of On the Margin. Today, I'm joined by special guest hosts, Jack and Byron. Fellas, welcome to the show.
Hi, Mike.
Great to be here.
Awesome. So pour one out this week for Mark. Mark is down in Miami for Bitcoin 2022. I'm sure he is partying and having lots of fun, no doubt. But Mark, we miss you, and I'll see you back here next week. Before we get into content, I do want to do a big plug for Permissionless and actually our Permies NFTs. So we've actually got the live reveal of our NFTs, and that's going to be in about 45 minutes from now. So I'm sure we're going to be deep into conversation by then. We might have to take a quick break because I want to see which Permie I ended up with. If for those of you who don't know, Permissionless is our big conference this year. It's going to be down in Palm Beach from May 17th through the 19th. It's the cultural event of the year, getting really deep into all things NFT, DeFi, etc. We've got some really great speakers, Do Kwon, Kevin Iwaki, the founder of Gitcoin, Chris Dixon. Really, really great lineup. I'll link it at the bottom of the page, but excited for this one. And Jack and Byron, I'll see you two in person down there, so should be fun.
I want to be there. And Mike, I just want to say I apologize in advance for how many times I've been like, hey Mike, my friend really wants to go. This person he's been on my podcast, he really wants to go. Come on, he's a Blockworks VIP. So it's some people bought their tickets in October and they were able to get an early seat, but now it's really they're selling like hotcakes, and everyone wants to be there.
Yeah. That was the most up-only thing you could have bought back in October. Our tickets went live at like $15. They've been up-only ever since. So if you got in early, maybe you could flip those bad boys. We've got a lot of different topics that we want to cover on the show today. Going to start more macro, and then we're going to zoom in and talk about some pretty interesting stuff that's going on in the crypto ecosystem. I want to start just by talking about what's going on in the bond market in general. So a mutual friend and kind of friend of Blockworks in the show, Jim Bianco, I thought had a really great thread just talking about expectations around the Fed's rate hike cycle, what's being priced in, and kind of what that means for bonds and then financial assets more generally. So to just basically summarize what Jim is saying, right now to talk about what's being priced in terms of expectations, there's an 81% chance of a 50 basis point hike on May 4th, an 87% chance of a second 50 basis point hike on June 15th, and a 65% chance of a third basis point hike on July 27th. This is a far cry. Like, I know now, people are getting more used to the idea that the Fed is going to aggressively hike. But I mean, if we return to what was being said, 3 to 6 months ago, this would have seemed completely beyond the pale, right? And I think the bond market is finally starting to wake up, right? So I know, Jack, you and I have been talking about, in terms of year to date, this is the worst start, especially on the long end of the curve for bonds since this started to get recorded back in 1990, right? So really, really tough start of the year, especially on the long date of the curve for bondholders. And the last thing that I'll say before I want to get your two opinions here is that, if you zoom out and look at how the Fed is probably reacting and thinking about this, let's remember that the Fed has a dual mandate, right? So Bill Dudley, the ex Fed governor, recently wrote about how he actually used pretty strong language that the Fed needs to take action again. The stock market should go down, right? So they've got price stability, which is inflation, which is going out of control, and then they've got employment. And Jim kind of wound up his thread by saying that we actually have something like 12 million open jobs in the United States and only 6 million people unemployed, right? So they've got latitude both in terms of asset prices in the stock market. They've got latitude in terms of unemployment. It looks like they're starting to hike aggressively, and the bond market is finally starting to take that into account. That was a big opening monologue. Guys, I don't know if you have any thoughts about Jim's thread or just the state of bonds in general.
Oh, I'll start, Mike. I think the animating principle is that bonds are fixed income. So there's only so much money you can make, and bonds pay 1%, they pay 3%, they pay 7%, and you own them in fiat, and they pay you in fiat. And if there's inflation that is significantly higher than, inflation's at 8% and the bond is getting you 2%, there's a mismatch there, and you would expect the sort of real rate of return to be somewhere around 0. But in December, inflation was at 6%, and the Fed funds rate was at 0%. That was quite a discrepancy, and that discrepancy is narrow. It hasn't narrowed if you look at the spot rate, because next week's inflation is likely going to be about 8.3%. That's the median expectation. And the current Fed funds rate is at 0.25. I think that's really key to underscore that so much of the tightening of the market is all just talk. It's all just people making bets on what the rate is going to be in the future. The current rate now is 0.25, and next week's inflation is going to be 8.3%. So I think the long end is pricing in all of that inflation that before they were saying, oh, it's not going to be. I think the bond market is sort of waking up to a secular inflation theme. I have definitely not been constructive on bonds for I don't know, at least over a year. I think that bonds might be they're definitely a better investment now than they were 3 months ago.
Yeah, I mean, I think the bond market is doing what the Fed wants it to do, so that's good. The question to me is why the stock market is not doing what the Fed wants it to do. I mean, financial conditions are definitely tighter than they were a couple of months ago, and that has so far just all been Fed jawboning. But the stock market is doing its own thing more or less. NASDAQ has sold off a little bit, but the S&P is still close enough to the all-time highs that you have to wonder whether the market is losing its signaling value, or if it's telling us something that the consensus narrative is not aware of.
Maybe another perspective, I listened to Brad Gerstner on the Arnold Lynn podcast last week, and his kind of perspective on this. The indices haven't really moved that much. The NASDAQ has sold off a little bit. The S&P is still within spitting distance of its all-time high. But what has gotten absolutely shellacked is those kind of, we've talked about this, the pandemic darling, type stocks like the Pelotons of the world and the Zooms of the world. Those are well off their all-time highs. So, one way of looking at what the market is doing is saying, people are moving out. If the risk spectrum is those very, very growthy tech stocks, they're kind of moving into more defensive stocks, like maybe FANGs have become defensive type stocks. And obviously, if you look at the composition of the indices, the NASDAQ and the S&P, the FANGs, the big tech, like mega cap tech, makes up a huge proportion of that. But on the other hand, we had Mike McGlone on the show the other week, and he was talking about just mean reversion, right, and gravity returning to markets. And I kind of agree with you, Byron. It looks like the bond market is starting to sniff something out, but the stock market, for whatever reason, hasn't reacted. So maybe it's just a matter of time. I don't know.
Well, I think there's an argument to be made that equities are something to own in an inflationary environment. So far, U.S. companies have been able to raise prices faster than their costs are raising. The profit margins for the S&P 500 are at an all-time high. So far, equities have been a good inflationary asset to own. And I think a lot of that is because, like you say, because mega cap tech is actually a defensive sector. But that's probably not going to last forever. Employees start asking for raises, and your fixed costs have to get replaced at some point. The question is whether the profit margins are sustainable.
Mike, you're absolutely right that the stocks that got shellacked the most were the speculative, non-profitable technology names that basically are essentially a bond, because all of their money that they're going to make is in 20 years or something.
Right.
ARK would be a highlight of that. I actually was listening to a presentation from Liz Ann Saunders from Schwab. I have a lot of respect for her. And she pointed out that the rebound we've seen over the past, let's say, 3 weeks has actually been led by those names. So there's been a pretty vigorous rebound in those speculative tech. Meanwhile, the core economy names, transportation, banking, real estate, shipping, things that move things from point A to point B, are industrial stocks that you typically associate with the cyclical real economy, they actually haven't participated as much in this rally. And that could forebode something negative for the economy. But I do just want to go back to this picture of bonds, because I think right now, yes, it's absurd. Inflation is going to be 8.3%. It might even get higher based on commodity prices, and the current Fed funds rate is 0.25. But if the Fed is going to hike to something like 3% by the end of 2023, and by the way, I actually think that is plausible. Some people think that's not at all possible. I think it is. That's 3%. Inflation is going to moderate down to, I don't know, 4 or 5%. I am an inflationista, but I'm I'm not a foaming at the mouth inflationista. And by the way, quantitative tightening, that is tightening, monetary tightening conditions of itself. And I actually was just speaking to someone who used to work at the Treasury, and they've looked a lot into this, and they said that let me actually get my numbers. About $120 billion per month is the equivalent of the 200 basis point hike for a year. So about the $500 billion quantitative tightening that we're going to do until the end of the year, based on what the Fed indicated in its Fed minutes, that would be about a 2 to 3 additional rate hikes. And if the Federal Reserve were to drain its balance sheet entirely to a pre-pandemic level of $3 trillion, that would be 400 basis points higher. So I can envision a world in middle of the year 2024 when inflation is 2.5%, 3.5%. Fed funds is still at 3%, but if you add on the QT layer at 7%, in terms of monetary conditions, fixed income is back to in the black instead of in the red. So I am thinking that bonds, they have obviously been a fantastic short, but I've gone from bearish to bonds to neutral on bonds, and I don't know. Maybe if TLT is at 120, maybe I'll turn bullish. I don't know.
I guess it just depends on how effectively inflation is able to rein in. And Zoltan in that I think letter that basically everyone has read at this point, he talks about this kind of Bretton Woods 3 framework and shifting from kind of a non-collateralized central banking system to one that's more collateralized, but the idea of commodities and stuff like that. And if you combine everything that's going on in geopolitics, a shift from the unipolar world based on efficiency to a multipolar world maybe based on resiliency, and that's a very inflationary type trend. So I don't know. I feel like I waver on this quite a bit, but I think there's a pretty decent chance that the inflation rate, I agreed, maybe it's not 10%, but maybe it's higher than your 2.5 or 3%. Maybe it's something like 5 to 6%, feeling more persistent. But
yeah, Mike, it's funny when we first met each other, I think I was the inflationista, you were the deflationista.
Yeah.
We flipped. I'm definitely not a deflationista, but here's, Mike, if we have secular inflation, it will be because of commodity pressures. I think that the fundamental demand style inflation that we've seen is running out of wind as we speak. And one aspect that is key to sort of the note, the short-term interest rate note heard around the world by Zoltan and Pozsar, is this reflexive dynamic where the price of wheat skyrockets. Egypt imports 80% of its wheat. How does it pay for that wheat? Well, it's going to raise shipping prices if you want to go through the Suez Canal. And then someone who has to pay that shipping cost, they raise prices. So it's this inflationary spiral. And Zoltan also talks about, I know Byron has some thoughts on this, but Zoltan also talks about how shipping companies and commodity trading companies in particular rely almost exclusively on bank financing, which is credit lines. And because banks have all of these reserves, they're essentially creating money from nothing. They don't have to tap the credit market. So you haven't seen credit stress yet, but that belies a fundamental panic that's going on in the banking system right now. Zoltan is flashing a warning signal and saying that actually quantitative tightening will be a disaster because the aggregate level of reserves that the banking system needs is actually going to be a lot higher because these commodity trading firms need all this credit line. So there will be a demand for credit like we maybe haven't seen in, 15 years. Byron, what are your thoughts on this?
I don't know. There was a lot in there. It's kind of where it's an unprecedented situation. Like, how important is the level of bank reserves? I don't think, we have no historical precedent to really go on. I think the real risk is unintended consequences. Like the Fed is attacking inflation by lowering asset prices because that's like the only thing that they can do, right? But do asset prices really matter to inflation? Like, is there a real causal relationship between asset prices and inflation? I kind of doubt that. So I feel like they're just going to do QT until something breaks, which is worrying. And it's also I don't know. I'm just uncomfortable with the whole thing. Like it just seems funny. The idea of deliberately causing unemployment and a recession in order to lower oil and gas prices just seems kind of perverse. Like, I guess there's nothing else to do, but it just seems kind of weird to me.
Yeah, thanks for that, Byron. I actually neglected to mention the core thesis of Bretton Woods 3, which is that there are four factors of money. There's par, there's interest, there is foreign exchange, and then there's the price level, which is inflation. And that fourth level, the price level, is something that the Federal Reserve does not really have a lot of control in. They are very effective at plugging holes in the financial system for the first three, but the Federal Reserve can't print ships, they can't print wheat, they can't print oil, and so the only way that they can is to curb demand on that stuff by causing a recession.
Yeah. But they're lowering demand for everything else because they can't directly affect commodities. Is that really a good idea? Like, it seems like it's going to induce a lot of pain for I'm not sure what benefit.
It's a blunt tool, I would say. And the other thing too about commodities, I mean, the other thing too is just labor markets in general. Like, I think the big, people focus on commodities a lot, and I think that's a big part of it. But also, the U.S. has basically had access to low cost labor pools in less developed parts of the world, and in a shift to a more regionalized, right, or a different kind of poles, right, of the world, that might not happen anymore. And I think that's another big part of it as well. That was the big thing for me, looking at the geopolitical conflict and being like, this will cause buildups in supply chains, but if the U.S. can't just plug into and leverage, this extremely large, very low cost manufacturing base that we've basically been leveraging in China, then suddenly there's a lot more wage pressure in the U.S. But I kind of want to. I want to get to what I want to get your guys' take on here is just how to play this, right, in general. Like, we were talking with Alfonso, who's been a more frequent contributor at Blockworks, basically about the risk reward of investing in risk assets, right? Because what we're talking about here, and for listeners, why we're focusing so much on how persistent inflation is going to be, is because if you have very high inflation and a Fed funds rate, even with all of these rate hikes being priced in at around 2.5 or 3%. What one world, like the Luke Gromen kind of eventuality, is an environment of sustained negative real rates. And that would be very bad for bonds, very good for risk assets. So in the short term, it seems like there's a lot of pressure it seems like it's a good environment for risk assets and risky tech stocks to sell off. But in the long term, the environment that we're describing actually might be quite good for those types of assets. So that's my question to you guys. Like, how do you think about kind of risky assets, especially crypto, I guess, in all this as well?
I think it's bad for bonds if they're negative real rates, but negative real rates on the long end sort of implies that there's the long end doesn't sell off that hard. So I think people on the long end will not experience huge mark-to-market losses. Like, TLT may not go to 40. It's currently at 125. Its peak was 170. But over time, just that 6%, 7% inflation will just eat it away like a little worm, like nibbling on an apple. But it's not going to be it's not going to be a huge material loss. And I think negative real rates are very good for risk assets.
Yeah, I think people complain about negative real rates and financial suppression and stuff, but I don't even view treasuries as an investment class, really. Like, treasuries are a savings account for people who have $1 trillion that they have to put somewhere or something, right? Like, treasuries are just not investable, and I don't think they ever will be. It's just like having a savings account at a bank. You don't expect to make a real return off the savings account that you have at your bank, right? And treasuries are just a savings account for institutional investors and foreign governments and stuff like that. Long term, I mean, there's the investing options for an inflationary environment are not great. I mean, real estate is the obvious one, but that's difficult to go in and out of. But it's probably sensible to have some degree of your portfolio in real estate. And then longer term, I do think equities are a decent hedge against inflation. Because just the earnings should go up, or at least revenue should go up with nominal GDP growth, and over the long term, companies generally can control their costs. So it's just another TINA thing. There's not a lot of alternatives.
Byron, if I can push back on that, I think treasuries are a savings account for institutional investors. Savings accounts typically don't experience mark-to-market losses. Like, TLT went from 170 to 125. If you had parked your money just in a bank, you would have lost money due to inflation, but you still would have had the money. So by taking on duration risk, you can be exposed to mark-to-market losses.
So
right?
they're even worse than a savings account. I was just making the point that like you shouldn't expect to get paid a real return for buying treasuries, which people seem to think they should do. But treasuries are risk-free. There's no reason to think you should be making a real return on a risk-free asset.
Speaking about potential issues that could exacerbate inflation, I think this is something that's going relatively underreported on, but there are COVID flare-ups that are happening right now in China again, specifically Shanghai, right? So Shanghai, kind of one of the most populous areas of China, some 26 million residents at the current time are locked down. They're reporting, flare-ups of, 20,000 plus cases per day. Yeah, this is big because, again, a lot of the manufacturing and exports comes out of China, right? So China right now is pursuing something that they're calling a zero COVID policy, right? This is coming kind of in the wake or this is when Xi is up for an unprecedented third election over there. So I'm not an expert on this kind of stuff. I don't want to opine on Chinese politics, but I mean, that could certainly be playing into things. But some pretty bizarre stuff happening over there. There's this video that's reported on CNN and other major news sites of actually, someone's dog being beaten to death in the streets, because the owner had COVID. Like, some really, really bizarre stuff. Obviously, China a little bit more strict about protests than areas like the United States, but, rare kind of pushback on social media and protests out in the street by really unhappy residents. I'm not sure if either of you guys have any takes on this or if you've looked into it or heard about it, but I think, it certainly is potentially interesting and definitely something to keep an eye on, I think, for listeners of the show.
Yeah, it's not good. I mean, on the one hand, it's inflationary because it just means that the supply issues are not behind us, which is disappointing. 2 years after COVID, we still haven't sorted out the supply chain issues. But then longer term, it's deflationary because of the Chinese economy is just not going to be very good. So yeah, I don't know how you play that from an investment angle. My personal takeaway is just that I think it's just more evidence that China is not playing 14-dimensional chess, and that centralized decision making is not better than decentralized decision making. Even though obviously the U.S. government is not a finely tuned machine and does a lot of things that are suboptimal. I still think it's a better governance model than centralized governments as they have in China.
Yeah, I think that the virus, it's inherently it goes in waves, and anytime there's a spike, that induces people either to self-isolate or, in the case of China, to impose a strict regime of isolation, and that themselves will cause the cases to go down. So I think a reopening is going to come over the next month or 2 months, and even though that will exert inflationary pressures in the U.S., deflationary pressures for shipping rates, I think it will actually have the reverse effect after 2 months. So I think it's kind of a cyclical thing, and I think this is only one of a myriad of China's issues, such as the ongoing deleveraging in its real estate sector, which is imposing material losses to a very large number of Chinese citizens. The real estate market in China is kind of like the stock market in the U.S., and people had bought paper rights to this building that never got built. So yeah, there are a lot of issues there. And then there's going on with China's buying commodities on the cheap from Russia because there's a geopolitical discount. But yeah, I mean, the zero COVID policy has been in place in China since the early pandemic. I mean, even before what we call the pandemic, because it started there. I'm just curious why now it's resulting in pushback from the citizens.
Isn't it just time? I mean, like it should get harder and harder to keep people locked down, right? Depending on and like some of these videos you can see, and I want to be clear too. I mean, it's hard to know what videos are real and which aren't, and these are just ones that I've seen circulating on Twitter. But I mean, some of these again, they've been aired on very legitimate news sites here in the West. So there are these videos of people saying I don't care about the restrictions anymore. I need to feed people. Like what at a certain point, right? People get desperate enough to go out into the streets, and actually generally that tends to occur around food prices, right? When people don't have any food. And one of the other things that's apparently happening in Shanghai, although there's immediate blackout over there, is food shortages. So maybe that could be linked to all this stuff as well. But I think, Byron, what you kind of said, it's just something to keep an eye on because, again, even though maybe we're shifting away from this framework, China is still the world's factory, right? So exports coming out of China is still very important, right, to the rest of the world. And it's kind of a leading economic indicator. So again, if they're just shutting things down due to COVID or for whatever reason, that's going to ripple out to the rest of the world in general. And I think it should be short-term inflationary, but we'll see. Speaking of, actually, one thing I wanted to get your guys' take on as well. So Peter Thiel did a speech down in Bitcoin Miami this week. I don't know if you saw this. Again, just classically, it was, the headline of everything. The only thing that I actually saw in the headlines was that he called Warren Buffett, what did he say? Like some kind of grandpa? Peter. He called him like a sociopathic grandpa from Omaha, basically. So it's some very choice words. He criticized the gerontocracy. There's a trifecta of Jamie Dimon, Warren Buffett, and Larry Fink. And he basically called Bitcoin kind of this revolution, this social movement, and it will succeed or fail due to political reasons more so than anything else. But actually, one really interesting fact that he apparently cited was... so this is a quote. So today, all of the gold in the world is worth 12 trillion, while global equities are worth 115 trillion. In 1980, the ratio is 1-to-1, with all the gold in the world and global equities having the same value of 2.5 trillion, which really, that actually blew my mind as a statistic.
That's a wild stat.
That's a wild one, isn't it? So he actually Peter Thiel, I didn't realize he was such a bull on this stuff, but he actually called for the value of Bitcoin alone, eclipsing eventually the value of the global stock market. So that would he said Bitcoin's got 100x from here and it's going to be a $115 trillion asset. That's Bitcoin alone, sans any of the other crypto.
Yeah, that is wild. The price of, he chose his dates well to make it a pretty drastic thing. If you, gold had a huge bull market from 1971 to 1980 and then was in a, trickling bear market that just destroyed a lot of people until 2000, and then 2000 to 2009 was bullish, and then there's been a reversal, and then now we've been in a bull market in gold since about 2016. I think there are a lot of fundamental reasons to be constructive on gold just in the macro world, but again, now that everyone's getting so bullish, is that the time to not be bullish? But yeah, I'm a huge skeptic of the belief that the monetary tightening is bad for Bitcoin. If you think that bank reserves don't stimulate lending, how do you think bank reserves go into Bitcoin? It's just it's 1 degree of separation versus 7. But yeah, that's a pretty bullish $100 trillion for Bitcoin. Byron, do you share that view? Are you as bullish as that or more bullish?
If the market cap of Bitcoin is ever equal to the market cap of global equities, something has gone horribly, horribly wrong. There's been nuclear war, or an asteroid has hit the Earth, or aliens have invaded. That is I just don't think that is an outcome that we should be hoping for. That would just not reflect well on the future.
Let me propose a counterpoint to that, though. Just devil's advocate argument for you here for a second. So A, do you think then that in 1980, when the value of gold was the same values as the stock market, do you think something was horribly broken back then? So that's question number one. And B, I actually really like the way you described U.S. Treasuries as not necessarily an investment asset, but more like a savings account for the institutional investor class, right? It's basically just cash, but it's cash that earns a return and appreciates, as opposed to cash that working class people have, and that actually depreciates over time. So Bitcoin almost flips that on its head, right? And Bitcoin makes cash available for everyone, and it's like this kind of global savings account. So on the one hand, I'm with you, and I kind of see it's like maybe that's not super productive, but also you could just see it as a big global savings account that's available to everyone as opposed to just the investor class. So that's my push.
No.
That's my pushback.
Yeah. So maybe, if you frame it that way, Bitcoin versus treasuries, I'd be more open to that argument. But I don't know. I mean, Bitcoin is a currency, which is fantastic, but the stock market is companies that employ people and that make things that people want and that are productive over time and make economies more productive and give us Netflix and Marvel films and stuff
I'm
like
with
that.
you. Yeah, I'm with you on
that to me is more, it's great to pay for all of those things with Bitcoin. I'm all for that. But I am rooting for companies to do well, more so than currencies.
Mike, also, your question is, in 1980, when gold and equities had the same market cap, do you think something was wrong with that? Well, wrong is like a kind of a judgmental term, but definitely there was a cause of it in that inflation expectations were sky high. Over the past decade, in 1971, we went off the gold standard system. The Eurodollar system was a jumble, and people thought that inflation would be at 10% for the next 30 years. So, that's why 30-year bonds were at, something like 15%, and gold seemed like a good store of value. But, from 1980 to 2019, it's been a pretty good, half century for fiat. So I think, Bitcoin inherently, forget if it was Zoltan who was saying this, I think it was on the Odd Lots podcast, that Bitcoin is inherently a short fiat currency. So it's unlikely, and this is Zoltan saying, that countries would adopt a Bitcoin standard in the same way that they might reimpose a gold standard. Although I actually do think that Bitcoin, not talking about a standard here, but as a means of payment, I mean, gold is just horrible. I mean, even back in the day, I mean, it was you'd get a note issued from a bank that would be linked to gold. Like no one ever went around paying for things in gold coins. You'd send a treasure chest full of gold to buy half of a country. But in terms of going to the store to buy shoes, like no one ever bought that in gold.
Yeah.
But I think it is possible, and maybe we can segue into this. Again, I know by far, among the three of us, by far the least about Stripe, but just Stripe. Sorry. See, I don't even know the name of it. Yeah.
Yeah. So just one anecdote about if you want to talk about just payments in general. Like the Rothschilds back when they were, funding wars and everything like that. And, depending on your view of history, pulling the strings, right, between different countries. One of their biggest challenges was actually simply moving payments from one country to another. And there are some really crazy anecdotes about all the investments they had to make in infrastructure to actually move their gold and silver from country to country. It's pretty interesting. But it is a good segment into Lightning, which is generally, again, something it's been hard for me to develop a lot of conviction on. So there are two big announcements, right? And both of these came out of Bitcoin Miami, that there were integrations from Robinhood. So Robinhood is integrating Lightning, and Strike, right, which is kind of this global payment system that is built on the back of the Lightning Network, is integrating with Shopify in general. So I think a couple of different things. So first, to just address the Robinhood, the Robinhood integration, I think it's smart. Robinhood has this huge base of kind of retail traders, right? They've got a lot of bad press and their stock price is down quite a bit, but they've got a great brand name. They've got a lot of really rabid users. And one of the big criticisms for their crypto platform was that you couldn't actually withdraw your Bitcoin from the platform. So kind of all the real crypto people didn't use that as an exchange, but now you can actually withdraw directly to Lightning, which is big. And then the Shopify integration is huge. It's like the largest e-commerce, platform in the United States, and enabling you to make payments in Bitcoin, I think is pretty big. But overall, I've just kind of noticed quietly that the Lightning Network is starting to get some more traction. There have been a couple ecosystems fund, there's this collaboration between OKCoin and Stacks. It's a $150 million sum fund to actually build apps and everything on Lightning. And it's kind of gone unnoticed. But I think, again, the payments use case for Bitcoin is one that has always existed. The narrative has shifted away from that recently, but I think this is pretty bullish. I don't know, Byron, if you have any thoughts on Lightning and these recent integrations.
Yeah, I think Lightning is great, and it's exciting that it's getting it's got so many more use cases now. I mean that's what makes Bitcoin a currency. Like things don't have to be denominated in Bitcoin. The unit of account is like the least important and least interesting aspect of money. Everything can stay listed in dollars, but if you can pay for it with the Bitcoin on your Lightning app, then that makes Bitcoin money. And especially in an inflationary environment, if inflation is really going to be secular, the problem of inflation is that you have X amount of dollars on your checking account just as working capital because you've got to buy things in dollars or whatever. So the degree that you can switch your working capital into Bitcoin, that has a lot of value in an inflationary environment.
Yeah.
Byron, can you just walk us back through argument you made in your newsletter a few months ago? By the way, everyone subscribe to Byron's newsletter. It's a great read. Just about how the dollar was, there are three services that money provides. The dollar is two of them. But Bitcoin is also two of them, but they're different in terms of medium of exchange, unit of account, and store of value.
Okay, the key thing in your statement there is months ago. So I was not prepared for this question. Months ago is a long time. Yeah, but the question is just, if I'm remembering correctly, the question was just, is what I think what I just said, which was that, what makes money money, and what makes money money is the ability to use it as a currency as a medium of exchange. The unit of account is not particularly important, but if you can, if that's the medium of exchange, which it is with Lightning, irrespective of what the unit of account is of the thing that you're buying. If you go to McDonald's in El Salvador, the prices are still in dollars, but you're paying in Bitcoin. So Bitcoin is therefore Bitcoin is genuinely money.
Right. So your argument was that the dollar is a medium of exchange and a unit of account, but not a store of value. That Bitcoin is a store of value and a medium of exchange, but not a unit of account. I would just push back on that a little bit, Byron, which just ask you a question, which is, I think when people, monetary theorists came up with the thing store of value, they meant that $1 now, in 5 years would still be worth $1, or maybe a little bit of inflation. Like, I don't think anyone used the term store of value to mean you'll buy it's $1 now, and then in 5 years it will be worth 2,000 times. Like, I think Bitcoin is has shown a remarkable ability to appreciate in terms of dollar terms, fiat terms. So is it really a store of value? I feel like a store of value would be something like a stable coin. Bitcoin has the potential to go up a huge amount, but you have to stomach a lot of volatility. And I think that is inherently not friendly to being used as a currency. You mentioned that Bitcoin was a mega savings vehicle, but it sounds like with the strike mechanism, we're not talking about a savings vehicle. We're talking about a checking account. There's a savings account and a checking account. So I'm curious what you think about Bitcoin's incredible ability to go up is actually a liability for a currency, because like if I'm bullet filtered on Bitcoin, why would I buy things in Bitcoin?
Just one thing to clarify as well about Strike. What's interesting about Strike is that Bitcoin. There's Bitcoin the asset, and then there's Bitcoin the payment network, right? So there's the capital and the lowercase b Bitcoin. So what's interesting about Strike and why it's an interesting integration for Shopify is that it allows the vendors on the Shopify platform to essentially leverage the payment infrastructure that underlines Bitcoin without actually getting involved in Bitcoin, the currency, right? The lowercase Bitcoin. So it's a weird kind of esoteric thing to try to separate out. But part of what's interesting about the Lightning Network and this whole integration is it allows you to bypass a lot of the like the credit card companies and a lot of the fees that are associated with that. And even if you start to look like deeply into money and how money really works in the U.S., I mean, I agree that central banks printing reserves, that is money, but at the same time, the very real money in the economy, like the M2, right, that comes from central banks. And a lot of that comes from, credit card companies as well. So it's credit creation, right? We kind of confuse credit and money in general. So I think to your question, Jack, yeah, I understand that the intense upwards volatility, prevents it from being used as a currency. But let's remember that Bitcoin isn't a mature currency, right? I'm borrowing this from John Pfeffer, but Bitcoin is a venture investment in a new currency, I think. I don't think that anyone thinks over the long term that anything that has a 100x upside from here is going to be used as a currency. That feels more like an investment. But the end stage of it is what a currency looks like. I don't know, Byron, if you think about it any differently.
I would just say that, store of value is an aspect of money, but it's not a prerequisite to be money. The dollar has never been a store of value and was not designed that way. The dollar has been a medium of exchange and a unit of account. But, if you buried your dollars in a tin can in the backyard, you have lost, 90% of your purchasing power over time. So Bitcoin doesn't have to be a store of value to be money, for one thing, but it is. The stores of value are equities and real estate and bonds, and all those things are volatile. But over the longer term, you have a better chance of buying the same amount of stuff in the future that you can buy with them now, and that goes for Bitcoin as well. It's just a more volatile store of value.
This episode is brought to you by Blockdaemon, the world's leading blockchain infrastructure platform. Blockdaemon's mission is simple: make spinning up a node so easy a 5-year-old could do it, and so secure that any chief compliance officer in the world could sleep easy at night. In plain English, Blockdaemon allows anyone, whether you're a crypto native fund, a financial institution, a DeFi protocol, whatever, to participate in crypto more safely. For some, that can mean participating in governance. It could mean gathering real-time and accurate data. It could mean generating yield through staking. Whatever it is, when it comes to crypto, infrastructure is edge, and there's simply no better edge offered than the one from Blockdaemon. Blockdaemon supports a range of services on over 50 protocols, and that's a growing list. They have multiple layers of risk mitigation that include regional and data center diversity, 24/7 human and automated monitoring, a full-service team of engineers to avoid technical difficulties, and things like slashing insurance. In other words, they literally make it foolproof. If your organization relies on real-time, accurate data that comes from blockchains, please, please, please click the link at the bottom of this episode and go check them out. Again, it's important. Gotta click the link at the bottom, otherwise I won't get my credit. Speaking of the creation of reserve currencies, I want to get into, and this is maybe a little bit more in the weeds crypto, but I want to talk about Terra, Luna, and the interesting $100 million purchase of Avalanche that they made this week. So again, for listeners, if you're not super familiar with what UST is and Luna is, it's a decentralized algorithmic stablecoin that's being built within crypto. And just to set the stage, again, hypothetically, if you were trying to create a currency that functions as a medium of exchange, like Byron was just describing, you need two things, right? You need demand, that is the demand side of things, which is actually you want people to want to use that currency, right? So maybe in the US example, the demand side of the US dollar is our economy and getting access to investing in companies and homes and things like that, which you have to use US dollars to buy. And then there's the reserve or collateral side of it, which we used to have in the form of gold in the Bretton Woods system, and now we don't really have anymore. But the demand side is still really strong. I guess the petrodollar. That is basically trying to be built right now in crypto with Terra Luna. So UST is kind of the product, and that's the decentralized stablecoin that's acting as a medium of exchange. And then you had Luna, which was the collateral system for that. A nonprofit's been formed called Luna Foundation Guard. They've been buying up Bitcoin essentially to collateralize the UST and give people more faith. There's the demand side of people wanting to use UST, but now it's actually backed by Bitcoin. People feel very good about that as a pristine form of collateral. There's been speculation for a long time that they were going to diversify their reserves outside of just Bitcoin, right? So I think they've bought over $2 billion worth of Bitcoin today. They have plans to buy $10 billion in some vague time frame over the course of the next year, but they announced a $100 million purchase of Avalanche or Avax this week, which I think came as I was surprised to see it, but then after I dug into it, I think it started to make a lot more sense to me as to why. I have thoughts on why in general, but Byron, I'd be curious to get your take on this. Just the sustainability, I suppose, of Luna in general, which seems to be something of a debate in crypto, and then also the decision to move into Avax as opposed to something like purchasing ETH.
It's looking more and more sustainable. It's definitely got an aspect of lendiness to it. Mm-hmm. There's just a lot of takeaways. It's really pretty fascinating.
Yeah.
Possibly the most interesting thing that's going on in crypto. One takeaway is just that it shows the power of having the ability to print your own money. Do Kwon and LFG are printing money, and people are accepting it. They're accepting it partly just because of the Do Kwon sort of creates demand for his currency just by force of personality, for one thing, but also because of all these different use cases that are being developed in the Terra ecosystem and elsewhere. The Avax thing in particular, I think, is super interesting because now Avax, the token, is becoming a mint burn mechanism for UST. So it's not only Luna that is backing UST now on the Avalanche chain. It's Avax backing it, which really I haven't totally processed what the implications of that is, but it just shows that Do Kwon has just very big ambitions. Which I think is fascinating.
I didn't realize I was assuming this, but I was assuming that the next asset that they would expand into buying is ETH, because that's a very large community. But Avax, again, I think if you were purely looking at this from the standpoint of collateralizing UST, right? So that kind of, we talked about the demand versus the collateral side. I think ETH would have been the choice. But again, maybe this just shows a little bit about their preference in terms of what they find more important, the collateralizing with reserve assets or actually going out and aggregating demand for UST. And I think they see Avalanche, and particularly like some of the subnets that are being built on Avalanche, like there's a collaboration on a gaming subnet in particular that seems really interesting. I think what they're doing here is saying demand is actually more important. And what we'd actually like to, we see more potential demand for UST, on the Avalanche chain than maybe ETH. And I think there is an aspect of community to this. Like when Terra announced that they were going to buy Bitcoin, what do people who like Bitcoin, what do they really love is when other people buy Bitcoin. And I think there's an aspect of that with Avalanche as well, frankly, where maybe purchasing Avax and aligning with that community, you'll get a more rabid support base underneath you than if you were to buy ETH at this point. There's also the aspect of like ETH and Maker, like those being kind of separate communities, but ultimately overlapping versus Avax. Luna is just like a cleaner way of doing that. So I think I just think it's really interesting. And where my mind goes immediately after this is like, okay, where are they going to expand next? Because maybe I was wrong at thinking that they would move into ETH the first time. So maybe what they're looking at next is Solana. And I would say too, if you want to put your little conspiracy hat on, that who is one of the biggest backers of the Solana ecosystem? Jump. And who's one of the biggest backers of Terraform Labs? Jump. So I'm not saying, but I think there's a strong case that you could certainly make that they might move into Solana next.
I think Solana has a native stablecoin though, right? I think Avax did not have a native stablecoin, and Solana does have one. So I think that was the attraction of Avax, not Avax as collateral. If he was just going for collateral, he would have just bought more Bitcoin or bought more, started buying Ethereum. He's bought Avax because he's got a chance of making UST the default stablecoin on Avalanche.
That's a good point. Yeah, I mean the UST story is probably, I agree. I think it's probably the most interesting thing going on in crypto right now. And if you look, like the one chart, like the most consistent chart in crypto is not Bitcoin or Ethereum or NFTs or anything like that. It is the market cap of stablecoins. Like it is a straight line up, and it's still going basically. So issuance of new stablecoins, and UST is taking a larger and larger share of that pie, I would say as well.
Yeah, stablecoins are weirdly interesting. It seems like they'd be the least interesting part of crypto, but they actually are the most interesting, I think.
Yeah, I think so too. The question is, what do you think about the regulatory implications of a stablecoin that is entirely backed by US dollars, like something like USDC, versus like a UST, which is in some ways actually kind of is very decentralized?
I mean, I think the interesting, or one of the many interesting things about the four pool news from last week is that the algo stable coins are really coming into their own, and now they're going to have a seat at the table with the collateralized stable coins. Frax and UST are potentially going to be as big as USDC and Tether. And I don't know what regulators do with that. I don't think they'll be very happy about it. I mean, I think regulators are going to want full collateralization with audits and everything, and that is not what you get with algo stablecoins. So I'm not sure what the regulatory aspects are, but it is Janet Yellen yesterday or the day before highlighted stablecoins and potential risks there, and I do think that there are systemic risks to crypto from stablecoins, and they are the algo stablecoins present a larger systemic risk. I think that to the degree that the algo stablecoins take market share from collateralized ones, and to the degree that they all get interconnected and start collateralizing each other, that the systemic risks in crypto are rising.
What about the argument, so just in terms of systemic risks, so regulators have talked a lot about viewing stablecoins as something that looks like money market funds, right? And that's like kind of like you could look at something like USDC, right? I mean, people put funds in, you get issued out this dollar kind of wrapped token type thing, and then the actual dollars that get put into like corporate debt and stuff like that, and there's a return on that, and that's the monetization scheme basically for USDC in general. So there's an idea that actually maybe regulators are even more worried about something like that, because like let's just say there's a world where USDC has a $1 trillion market cap, right? I think what people are worried, what regulators tend to worry about, and one of the big lessons from the great financial crisis was, the stability of money market funds and short-term funding markets in general. And that's what that money markets sit right at the heart of that. So what people are worried about is like a run on money market funds, where if people are trying to get out, quote unquote, of crypto, they could essentially cash in their USDC, and then Circle or Center or whatever the organization is would have to sell off that corporate debt that they have, or whatever their assets are, and that could be systemically risky. As opposed to regulators might just look at a decentralized stablecoin and be like, that's all in this cryptoverse anyway. That doesn't really matter. That's not going to impact the real world. Do they really care if Avalanche sells off? Because Luna has to dump their Avax. Like, I don't think so. But they certainly would care if USDC has to dump $500 billion worth of corporate debt. That would be very concerning to them. So maybe counterpoint.
That's a good point. I hadn't thought about it like that. But an algo stablecoin, I guess, has no transmission mechanism from crypto into real world assets to cause any trouble. I guess the regulatory concern then would just be investor protections, right? Like if investors are all using stable coins for their as savings accounts because there's higher yields than in their actual savings accounts, and then you can have bank runs in algo stable coins. Maybe the investor protection angle would be the regulatory concern rather than real world contagion.
The other thing I wanted to get, Byron, I know we're running low on time here, but you described the four pool. Can you just describe what that is, why that's an important, just what the four pool is and why it's important in general?
Well, it's not anything yet. I don't think it's a proposal at the moment. But the idea is to replace the three pool with the four pool. The three pool is the pool of stable coins on Curve, which is the automated market maker for stable coins that provides a lot of the liquidity for all of DeFi. And at the moment, the three pool is USDC, Tether, and DAI. So no algo stable coins in there. Do Kwon has a personal beef with Dai, I think just because Dai insulted Luna on Terra at some point. I'm not sure exactly why. And Dai has been a little bit of a freeloader in the whole curve wars thing because they have not really been growing, but they're in there in the primary liquidity pool. So this proposal for the 4 pool is to make a new primary liquidity pool of USDC, Tether, Frax, and UST. So dropping DAI. And they're going to incentivize that pool with all of the convex that is owned by Frax and Terra. And that will probably be able to make 4 pool the default liquidity source of liquidity for DeFi over the 3 pool, which the curve pool, the curve wars get very complicated.
They do.
But I think the basic takeaway is that the primary pool of liquidity will switch from being the original stable coins of USDC, Tether, and DAI to being USDC, Tether, and the 2 rising algo stable coins, which is Frax and UST.
Mm-hmm. Well, there's obviously a big I mean, stable coins, interestingly, to your point, they almost seem like something that's dull, but they're actually kind of emerging as the killer use case of crypto, and they're not, the use is not diminishing, right? Bull versus bear markets or whatever. Again, issuance of new stable coins is kind of a steady rise, and I've actually, so Blockworks, right, for permissionless. We've sold to many more crypto native companies, right? DAOs are involved primarily as sponsors for the conference in general. DAOs like to pay in native tokens and USDC, et cetera. So we've gotten an enormous amount of payment recently in USDC. And for the first time, Jason and I are kind of talking about, do we move this back into the fiat banking system, or do we keep this in crypto where you can earn pretty risk-free, meaningful interest? So you can actually, now that it's not a theoretical thing, I see very real firsthand why a lot of this money is quite sticky when it enters into the crypto ecosystem. Not to mention, you can just move it around much more easily and transfer it. And again, it's this kind of for companies in crypto that have adopted this, it's like annoying to get a bank wire, right? Because you have to go do all these things. It's just much more cumbersome. So I kind of, I understand why that's been a steady rise up. You actually have a lot more utility for your money in at least some senses, right? Keeping it in.
I guess one also to tie it together with the previous discussion on Luna is that Do Kwon and LFG they want to buy a lot of Bitcoin, obviously, and also Avax and other things, and to do that they have to sell UST. So the 4 pool is going to create a giant new source of liquidity that they can sell into. So it's all part of Do's master plan, and I think it's just really amazing the way that he can create demand for the UST that he wants to sell in order to buy as much Bitcoin as he wants to buy.
Yeah, I agree. All right, guys, we're running low on time here. I guess just any closing thoughts or anything that you're paying attention to that you think is getting underreported or stuff you're digging into, find interesting. Jack, I know we got really into the weeds there with some of the stablecoin talk, which is a little bit more outside of your direct focus. But what else are you kind of thinking about heading into the week that people should be aware of?
Well, next week is the inflation print. The median expectation now is 8.3%. We've had huge surge in the increase of gasoline, oil, and key commodities. So I think it could be a pretty hot number, and it'll be interesting to see how the bond market reacts to that. A few quick plugs. I interviewed Roger Lowenstein, who's author of When Genius Failed, and he has a new book about Lincoln and the financing of the Civil War. Very interesting. It's really witnessed the birth of the dollar. So that airs on Sunday, April 10th, and then on Tuesday, as always, I'm talking to Joseph Wang with George Goncalves, who's an interest rate strategist at MUFG. Also, just thematically, I actually had a lot of time to listen to you guys just talk about stablecoins, and I'm kind of I have Zoltan on my brain, but one of the key aspects of money is par. In other words, a bank deposit at JP Morgan is worth the exact same as a bank deposit, $1 at Bank of America, which is worth the exact same as $1, a dollar bill in your pocket. And I think stablecoins have the exact same thing. I'll give you USDC, you'll give me USDT, I'll give you UST, you'll give me a dollar, my bank, it's all relies on this par. And the TradFi world, going all the way back to, like 5000 BC, is replete of examples of there being a system of par that ultimately breaks. And I think the last time par broke was in 2008. And I don't think crypto has had a huge macro liquidation. Like by macro I mean systemically. You've had drawdowns, but I don't think there's been that thing. And it'll be interesting to see how that system evolves.
Yeah, just on that, it's just the four pool and everything that's happening around that and the curve wars. I think that's those risks of a major depeg that would look like a TradFi bank run are rising, although I think that's still pretty far in the future. And then one thing to look at, maybe to kind of bridge crypto and macro, is Frax is dropping a new coin, FPI, which is going to be a stable coin linked to CPI. I don't know how that's going to work. I don't think they've released the tokenomics and stuff yet, but I think it's going to be super interesting to look at and see how it goes. I think as long as CPI is printing 8%, being able to buy a stable coin linked to that would be of a lot of interest, I think.
Oh, sorry. Just last thing. This is I think it's really exciting because a lot of crypto, we think of crypto as real assets, but I think in the nominal world versus the real world, real worlds are things you can touch. Crypto, like the traditional finance system, is in the nominal world. But I think if crypto could sort of hop and leap over the fiat world and have things that are backed by oil, backed by gold, backed by interest rates, or backed by inflation, like Byron just said, I think that's something that is very exciting and definitely has a huge use case.
I agree. Yeah, the irony in some ways of what Doe and Terra are trying to do is they're reconstructing something that looks much more like a Bretton Woods type system with actual reserves than our current system today. Like I know, Jack, one of the interesting things just in terms of a commodity based reserve currency, it's that becomes pretty tricky, honestly, when you don't have a commodity that feels very fungible, right? Like I get gold as a backing commodity, I get oil as a backing commodity, but it's starting to talk about things like wheat. Wheat is not like a fungible asset around the world, right? And like Byron, I know we were talking about, there's a big difference even between like wheat reserves in China versus the U.S. because the U.S. has a much greater capability of producing wheat, but all these are interesting unanswered questions. We also just did the Permies reveal. I got to go see what my Permi looks like. So this has been a ton of fun. By the way, folks listening, if you hadn't gotten your Permi yet, they've all been minted, but you can go to OpenSea or whatever and potentially buy one. But they're great. You get all this. It's a lifetime pass for permissionless.
Mike, who are they going to buy it from?
I'm not selling mine either. Yeah, I don't know. Maybe you can find someone, but they're great. It's a lifetime pass for permissionless VIP for this year's event. A ton of great stuff associated with it. Fellas, this has been a ton of fun. Mark, again, we miss you. I'll see you next week. And cheers, guys. Thanks for coming on.
Thanks, guys.
Thanks for having us, Mike.